Hi everyone, I'm Vishal Kshatriya and I'm a part of the Edelweiss group, and I'm working over there as a research analyst. So total number of years of experience in capital markets is around 9 years, and my core expertise is pure trading, and that too with a perspective of short to medium term. And throughout my career, I was broadly into recommending stocks for short-term, medium-term investments to a lot of my clients. So a lot of experience I've gained speaking to various clients, and I've seen how people trade in the market, how they invest in the market. The way they approach is completely different than what the ideal approach should be. So that's why I've chosen this topic, 3 pillars of stock trading. And this is a topic which is not very simple. It's a very basic topic, but this is very much necessary for each and every one who is currently doing investing or trading in the market, or anyone who is planning to start investing in a trading market. This session will be very helpful for one who is actually investing in the markets. Before I start, if I ask everyone how to start a car, the very natural answer which comes to the human being is very simple. Just round over the key and car will start. Just press a clutch, put the car in the first gear and go ahead. That is not the correct answer actually. Correct answer is, before you start driving a car, you have to open the door for the car, you have to get inside the car. And this is the area where most of the traders, most of the people who start investing in the market or start trading in the market miss out. And that particular step, which I am saying, you have to open the door and start trading in the market. You have to open the door and get into the market. That is all about 3 pillars of the market, which most of the traders or most of the people who are right now into the markets are ignoring this. What is happening right now? Oh, one of my cousins is trading a lot in the market. He makes profit 2 days, he makes loss 1 day, but net he is making profits. Oh, my uncle is trading, my father is trading. Okay, even I should start trading. You know what? There are 5 people in my group who do a lot of tracking the stock market. But unfortunately, you know what? They are not making money. But still they are insisting you. It's fun, it's excitement. And what they say, it's very simple. Trading is what? Just buy a stock when it is at a lower price. Just sell the stock which is at a higher price. So it sounds very simple and very basic. That buy the stock which is low, sell the stock which is high. And you know what? 2 days you will make profit, and that friend will come to you and he will say, you know what, I made $5,000 bucks. So my whole weekend I can spend very joyfully and very entertaining. And the next weekend you make losses. And this will go on and on. You will never be a successful or professional trader because you will not have a sustainable income from a trading perspective. So why I chosen this topic is to understand that the core pillar for a successful trader is 3 M's, and that is what we are going to discuss one by one. So I just given this summary of the slide. So I've given you an introduction. So what we are going to have in this session, one is introduction, the 3 M's of a trading which I was trying to discuss right away. Pillar 1, pillar 2 and pillar 3. 3M is mind, method and money. Each and every pillar is very much important, and I'm 100% sure every one of you, whether you are trading in the markets right now or who is about to start trading in the markets, you must have never ever thought of how should I approach to the market before entering into the market. So this is what I was trying to say everyone, that you know what, one of my friends is very actively trading in the market, he is investing in the market, and when you ask him how do you invest in the market, how do you know which stocks to buy and which stocks to sell, the simple answer what they give is, when price comes down you have to buy, and you know what, when price goes up you sell. This way you will make profit. But if this was the trading philosophy or investment philosophy, If this work was so easy, then successful trading would be so easy. Everybody in the world would be a trader. But you know the fact, after my 10 years experience in the capital market and trading and investing, the fact is only 2% of the total 100% is actually a successful trader. They have converted themselves to successful and professional traders. So what is the qualities of the successful traders that we are going to discuss today? And this is the qualities which has been missing by a lot of people who trade in the market, just because the basics of trading is not, concepts of fundamentals of trading is not very clear, and they are not following this fundamentals. And this is what we are going to discuss today. Three M's of the market. So this is what we are discussing about. Trading is nothing but buy the dip and sell the dip. It sounds very easy. Whenever there's a dip in the markets, whenever market falls, you just buy. So my question to you people is, if current price is 100 and if it falls to 98, is that a dip? Or when current price is 100 and it falls to 92, is that a dip? Or when it falls to 80, is that a dip? You just can't know when the dip is, which is the ideal dip to buy. You have to have a proper method which defines, which helps you to identify this is the right time to enter and this is the right time to exit the trade. So buy the dip and sell the dip. It's so easy to speak and so easy to listen, but is successful trading that simple? It's not that simple. In fact, the trading is the most toughest thing in this world. The only thing is, since there is no entry barrier, people just a lot of people tend to come into the markets. So when your friend asks you or must have informed you that, you know what, I had bought this share today, and you also go and buy. There are some set of people who will ask, why should I buy? And there are some set of people who will be just driven by his advice and say, okay, even I'm going to buy it because my friend has bought it. Right? This is what happens. And then what happens? Suddenly things doesn't work, or things may work but it may not work for a long time. So trader, when you buy a stock for the first time, or when you're buying a stock for several times, the expectations, what are the expectations you set from the market? There is only one expectation, that you are going to make a profit from it. Right? But if you don't follow proper method, which is the three pillar, if you don't follow these three pillars, you are going to wash out from market. That is for sure. Markets will completely eliminate you because you are not a disciplined trader. So these are the various form of behavior. So professional trader is a disciplined trader. He waits for the right opportunity. Whereas a beginner, how does a beginner behave? A friend of mine, he came up one day and he said, what should I buy? What should I buy? I just said, have you ever traded in the markets? He said, no. I said, okay, this stock is looking good. Without analyzing what does the company do, how is the company behaving, what are the price of the company, is the company overvalued, is the company undervalued, how should I buy? Without analyzing the base of the decision whether to buy or not, he just bought. So beginner tend to be very impulsive and they take a decision which is completely based on emotions or advice of the others. And what will happen? they will be washed out by the market. So here comes the trading basics. How long it takes to be a successful trader, and how much it costs you to be a successful trader. Well, there are people who have taken more than 20 years to be a successful trader, and hence they are able to have a sustainable and constant month-on-month positive income. And how much it costs, you never know. There are people who have understood the trading psychology, the trading behavior, the discipline, the relevance of the 3M of the trading, and they have adopted that in their life, and they have become successful in the 6 months time. So it all depends on the trader's individual discipline and individual goal, and to how to become successful. So what we are going to do is we're going to start one by one the 3 M's of the trading: mind, money, and method. It is often said that if you master your emotion, you will be the master of the market. So these are the 3 pillars: mind, method, and money. We have used more visual content in the slide. This will help you to remember a lot while you are trading. So this is what exactly we are trying to see: mind, method, and the money. If you take out one, in this slide we have taken out money, market will throw you out. If you take out mind and keep method and money as it is, you will be thrown out. None of them can be taken out. You have to have discipline to follow what mind, what method, and what money, all these 3 psychology or the 3 pillars says, and about how to approach the market. So let us come to individual. Mind refers to trading psychology. Methods refers to the rules you set for deciding when to buy and when to sell. Right now, 99.99% of the people who are doing short-term trading or who are investing would not be having any reasoning for why they are buying or why they are selling. Why they buy? Because somebody has recommended. Because my friend is buying. Oh, you know what? I just read yesterday in a newspaper that this company is doing well, so I'm buying. Somebody on television has said that this company is good. This company is manufacturing a product which is in a very high demand, so I'm buying the stock. So you need to have a proper methodology, a written methodology. I would say a written methodology wherein you will say, if this thing happens, I'm going to buy, else I will not buy. Money refers to the money management, how you are going to manage your money in each and every trade. I will take the money management part in a more detail when we come to the individual section. Let us start with the mind. So as I mentioned, mind refers to psychology. It is often said that master your emotion, you can master your markets. So there are 3 important factors or 3 important emotions which comes into your mind while trading. The first is greed, second is fear, and third is ego. The one who are trading, they will be able to understand this. What is the greed? What is the fear? And what is the ego? Well, every moment of your trading, whenever you have bought a stock, till the time you don't sell, each and every point of time, your psychology, your mind is behaving either greedy, either fearful, or egoistic. So let us discuss one by one. What is greed? Greed refers to desire to make a big money, and that too quick money. So it's a big and quick money. So what today one of your friends said, you know what, stock which I am buying always goes up. So he bought 100 shares. And at the back of the mind, you have that particular information that stock which my friend buys, Mr. X buys, always goes up. I have so much money in my account. Can I buy it right away? Can I put all the money in that particular stock and make quick return and a big return in betting? This is what the greed is. You want to make a very quick money and you want to make in a very short term time. This is a disaster. If ever you think this way, that I want to make a very quick money and that too in a very short term, that's a greed. That's a greed which is coming in a way in your mind. Also, the second part, risk too much of the capital. What I was saying, you put all your bank account balance in one particular stock. Out of 100 rupees you have in a bank account, some money you need for your survival. You can't bet everything on one stock. That's a greed, that you want everything and you want to double your money in a very short time. Stay in a winning trade too long. What does this mean? Suppose you have done your own analysis, and based on your analysis, you came across that this stock has a potential to move from 100 rupees to 110. So you buy that stock. Stocks gradually goes up. 103, 105, 108. Now, the target what you have is 10%. That is 10 rupees on 100. And right now you are making 8 to 9%. You just don't want to leave that 1 rupee also. And what traders normally do? No, my target is 110 and I am going to wait unless and until my price doesn't come. Well, this is a greed. This is the ego. You have to understand that this is the markets and not a mathematics. 2 plus 2 is 4, that is okay. But in markets, 2 plus 2 maybe 3.5. You have to understand this. You can't have 100% of the rally. So if stock rally from 100 to 110, you cannot gain that 10 rupees from the market. See, what is the psychology of a trader? You know what? In 1 year time, one particular stock has moved from 100 rupees to 500. And you know what? I just made 100 rupees from that particular stock, and that stock has moved 500 rupees. Is that a good trade or bad trade? Some people will, majority of say it's a bad trade. I would say no. It depends whether it is good or bad. If you have done your own analysis and you have arrived at a decision that this stock has a potential to move from 100 to 200 only, and you have exited at 200, it's a good trade because things have happened the way you expected. After 200, stock has gone 500. That was not your expectations. It has happened because market has discounted something else. So please understand, greed is the thing which is very disastrous for all the traders. Out of greed, one of the most dangerous tools is desire to make a very big money, and that too in a very small span of time. This is the biggest disaster. If you do this, you are not going to survive for a long term. Luckily, you can gain if you buy one stock, and if you are lucky enough, you will be able to make a quick buck in a short term. But yes, the survival will be very difficult. So, how can you eliminate the? How can? can you unmute your, can you mute your phone, please? So how to eliminate this greed? We have spoken a lot about this greed, what happens to a trader's psychology. The first and foremost thing is form a realistic goal. This could be, okay, I want to make this much money in a month's time, in a week's time, in a 6 months time, in a quarter time, or a 1 year time. And this goal has to be realistic. So if you're investing 100 rupees, I would say, I don't want to make 200 in a week's time. This is unrealistic. You have to be very reasonable. Trade with a plan. Just don't buy and sell the stock which has been recommended by your friend, which is recommended in a newspaper, which is recommended in any magazines. You have to plan your trade according to yourself. This is the only way. If you are going to be dependent on someone, this is not the correct way of trading. This is not a sustainable way of investing or staying in a markets. Avoid trade which are unfavorable risk and reward, and chase overextended trends. So what are this unfavorable risk and reward, and what are this risk and reward? So today I say you go ahead and buy stock which is currently trading at 1,000. I would say this stock can go 10 rupees from here. So 1010. But you know what? This stock has a potential to move at 10 rupees from here, but it can move down to 50 rupees from here. So what is the risk you are taking? 50 rupees. So what is the reward you are expecting from the trade? Just 10 rupees. So what is this the good trade? Is 50 rupees. The reward what we are expecting is 10 rupees. So this is not at all encouraging. The risk reward is not at all encouraging. The risk you are taking is 50 rupees. Reward you are getting is 10 rupees. So this is unfavorable trade. Often greedy people tend to enter into trade which is unfavorable risk reward ratios. Why this happens? Because suppose you are tracking one stock for last 2 to 3 days. That stock has gone from 1,000 rupees to 1,100. From 1,100 to 1,200, and then you think that I should buy this today, and you know what, before you buy it suddenly shoot up and it goes to 1,500. Now what to do? Now you will become more greedy that this stock is continuously going up, and you will enter into a trade at 1,500 rather than 1,000. So now the stock has already tried 500 rupees from here. Potential of stock further going up could be 50 rupees or 100 rupees, but since stock has rallied almost 500 rupees from here, the potential of that stock falling will be 250 rupees. So risk you are taking is 250 and the reward what you are expecting is 100 rupees. So don't chase the stock, don't run with the stock. Have your own trading plan. That okay, I will buy only when this conditions are met, then only I will enter into a trade. By doing this, you can completely avoid a greed factor in your mind. Once the greed factor goes away, the next factor which comes is fear. What is fear? Fear is defined as a feeling of apprehension. Now, fearful thoughts can be classified into two terms. Two people. The first set of people is the one who are actually trading in the markets. They're buying shares on a weekly basis or a monthly basis or maybe daily basis. And the second type of second classification of the people would be the one who are about to start the trading. All his friends are saying, you know what, trading is a very exciting game, very good job to do. It's very exciting. You should also do. But since he has not got any shares in his life, he has a fear. So fear generally comes when there is a lack of faith in yourself or lack of faith in your trading plan. Suppose you don't have a plan and you have bought any stock which is based on the recommendation of your friend and the stock start going down. What will the general feeling you will have? You will just start thinking this way, why the stock is going down. You will have no clue why the stock is going down. Why? Because you have not done your homework on that particular stock. You don't have a trading plan to buy any stock. So when the stock starts going down, you will have a fear. Will it go up again or not? Will it further come down? So this is where you have to prepare a trading plan to avoid the fear from your psychology. Secondly, second type of people who has never traded by natural since he is doing first time in his life, the fearful thoughts will definitely come. What will happen if I buy the stock? It may or may not go up. If it doesn't go up, I will lose money. So this is a second class of people who have fearful thoughts. Third one, a trader who is beaten up by the market. So now, based on a friend's recommendation, you have bought the stock and it goes down one day, second day, further it goes down, third day, further it goes down. So for 5 consecutive days, the stock keeps going down. So what has happened with you? You made losses and market has beaten up. So what you will do on the 5th day, you just can't take it and you will exit from the stock. So now what is your state of mind? You have already made a loss, which is unacceptable for you. So market has already given you one slap. So what will happen? The next trade which you will trade, which you are going to take, the next stock which you are going to buy, you will be ultra cautious. Should I buy or should I not buy? You will think 10 times before buying another stock. And the moment you buy that stock, and if after buying immediately it goes down, immediately a fearful thoughts will start coming into the mind. That last time it happened that on a one day stock has gone down and I was not able to exit. And on the 5th day I have to exit with a huge loss. Now today is the first day, should I exit or should I hold on? Second day, what's happening? This is another tick down and you will exit, and after exit, you know what? Price will go up. So this kind of fearful thought will keep coming to the trader's mind, and this is also one of the most important things. If you have a proper trading plan, if you have a proper defined plan, I will buy this stock at this price and I will exit at this price. If you have a defined plan, the fearful thoughts will anyways go away. Secondly, suppose you have 1,000 rupees to be invested in a market. Do you buy a stock worth 1,000 at a one go, or you will first try and test yourself? I will buy 200 worth of stock right now. Let me see what happens. Okay, things are going well, I am understanding. Then you will further invest 200 rupees more, so total 400. So gradually, as you get experience, as you get a hangover of the trading, then you start increasing your capital. But if you, in a first thought, at an initial stage only, if you risk all your capital, you just buy a stock worth 1,000, immediately, just on a first trade, the level of risk you are taking is very high. So whenever the level of risk you take in each of the trade is very high, your thinking process will be blocked by the emotion, and that emotion will be fearful emotion. Oh, you know what? I had bought a stock which is 1,000, and I don't have other money. If I lost 1,000, or if I even lost 200 rupees from this 1,000, it will be a big hit for my bank account. 20% cut. I just can't bear it. It's too risky for me. There are a lot of people who say this, right? Stock markets are too risky. It's not too risky. It's just that you are taking a lot of risk. The ability of a loss which you can bear, only that much you should take a risk. If you take a higher risk, there will be higher emotion, higher fear in your mind, and you will be not able to concentrate properly while trading. You will not able to follow the plan which you have prepared for yourself. So, to avoid the fear, what are the things you are going to do? So this is what I was trying to explain. As the risk goes up, the ability to perform goes down. Why this happens? Because you will not be taking the right decisions. Your decisions will be influenced by the emotions, fearful emotions. So how can the fear, a feeling of fear, can be eliminated from your mind while trading? The first thing first is trading loss. You have to set a mentality in your mind that yes, I can lose money in the market. I'm ready to lose the money in the market. Let me give you one example. When you start any business, are you sure that you're going to make profits? Are you sure that the product which you are going to manufacture and which you are going to sell will be successful? If it is not successful, at the back of the mind you know that if I'm not able to sell my product, I'm going to lose money. But does that stop you from doing business? No. Same way, when you're buying a stock, when you're investing, when you're trading, come with a mindset that okay, I'm trading, I'm buying, I'm investing a stock in capital markets. It's not necessary that every time I'm going to make money. I may lose. Out of 100 rupees invested, I may lose 20 rupees. I may lose 30 rupees. But you have to have that kind of mindset that yes, if I invest, I can lose money. I will lose money. And it should be okay to me. And you know what? If it is not okay that you are going to lose money, then you should not come to the market. Please understand, this is one of the most important mindset which you have to develop to avoid the fear from your mind. Start accepting your losses. Acknowledge that okay, investing, trading is also kind of business. Just the way business can lose money, same way by buying a stock or investing can also lose money. If you start accepting this fact, the decision what you will be making will be much more rational. Prepare a proper trading plan. Now 99% of the people what I've seen in last 10 years, they don't have a plan. They just invest based on friends' recommendations, television recommendations, somebody must have told, some relatives must have told. You have to have your own trading plan. Decide adequate position size. So you have to decide on a day one that I have 1000 rupees and I'm not going to invest 100 rupees in individual stocks so that I can take 10 stocks at a time. You just can't have 1000 positions in one single trade. Ego. Ego refers to personal self-esteem. So you know what? When you take a first trade, you make 20 rupees. When you take second trade, you will make 30 rupees. When you take third trade, you gain 100 rupees. And now you know what happens? Suddenly, you will be very proud of yourself, and ego will come in your mind. You know what? Whatever I buy, it just goes up. So that kind of ego feeling will lead to a wrong decision making. So you know what? You will start saying to the people that you know what? Whatever stock I buy, it just goes up. You also buy, and now what happens? It just goes down. Out of ego, you miss selling at the right price previously. Why you are the winner? Because you are following some trading plan. Now, because of the ego which is coming in your head, you just miss the sell signal given by your trading plan, and you start losing money. So this is stubbornness. I will not sell this share, come whatever may be. You know what? I bought this share, and this share after I buy this share has to go up. If it doesn't go up, there's a problem. If it doesn't go up, I will not square off. This is a stubbornness. You should not be stubborn. Trader should simply start accepting the losses. I bought one share, it goes down. Okay, no problem. I will accept the loss and exit from the trade. Second time I buy, again it has gone down. I accept the loss and go away. You keep accepting the loss. This will help eliminate fear and ego from the markets. So this is what exactly I was trying to say. Behavior of a trader. A winning trader will always say, you know what? He will be very proud. Whatever I buy, it always goes up and I always make profit. And he misses the signals. His trading plan. He will be, why he has been a winner? Because he has been following the trading plan, which has led him to a winner. The moment he starts claiming that, you know what, I'm a winner, a bi-natural ego comes to the mind, and then he will start making losses. A fearful trader. These are the trader who has been continuously losing money, and hence the confidence level of that trader is very low. And what happens? The moment stock goes down, he exits. Then after going down, stock goes up, again he will start buying. Why? Because he will feel that I will miss this rally. Again it goes down, again it's so. Why this activity is happening with the fearful trader? Because he has not prepared a proper trading plan. Third, the emotional trader. What will happen? You know what? I just love Reliance. I will never ever sell Reliance. So they become in love with the stock. And you know what? They will start saying, this is a stock in which I never make money. This is not a correct way to approach. The correct way to approach is buy the stock, sell the stock when your trading plan says exit. There is also one important parameter what I wanted to highlight is short-term trading gets converted to investment. So you buy a stock, say for example you buy a stock for ICICI Bank, and since last 3-4 days the stock is going down a bit. Now you buy the stock with a short-term capital, short-term gain, and you just want to make quick buck of 100 rupees from the ICICI Bank, so you bought the stock, and then stock start coming down. You start making losses and you are not ready to accept the loss. So you are making 20 rupees of loss. Now further it goes down, you make 50 rupees of loss. You just can't accept this. And you know what? You will try to convince yourself, which says, you know what, ICICI Bank is a very good company. Right now it's going down. It will again come up. And you will convert your short-term trading into the long-term investment. And this is the biggest disaster of everyone. The one who converts your short-term trading into a long-term investment, that's the biggest problem, and he will never ever be a successful trader. So, a summary what I would like to highlight over here is trader has to be disciplined enough to follow one, his trading plan, risk he takes in each and every trade, that is a position sizing. Should avoid wishful thinking. He should not be hopeful. He should not put his fingers crossed when he buys. Just okay, the stock which I have bought is going down. Just accept it and exit from that trade. Don't be fearful. Don't be emotional with that particular trade. Avoid stubbornness and keep learning from your previous mistake. This is one of the most important things. The mistake which you have made, you have to analyze. Oh, you know what? In this case, what I say is the bank based on this plan. But it didn't work out. Why it didn't work out? Let me go back and see what was the mistake I did. And you keep learning this mistake. The second pillar is method. So, method refers to analysis, tools, techniques which has been used by the trader to take a buy and sell decision. So, a dilemma which trader which needs a feeling or a lot of thought which keeps coming or popping into an investor or trader's mind is what market to analyze, how many markets to analyze. You do know there are so many markets. I will come one by one. Which market to analyze? And should I invest or should I do short-term trading? Should I do long-term trading only or should I do only one day intraday trading only? Trader has to answer himself based on his stress level. So different kind of markets which are available or different kind of tools which are available for analysis are fundamental analysis, technical analysis, derivatives, quant and intermarkets. In a very brief manner, I am going to take each one by one, but let me tell you, each of these parameters are very vast, and it takes me 2 days to explain each and everything. But this is since we are going to focus on the 3 pillars, we are going to take this in a very short way. Fundamental analysis, as the name suggests, and everybody of you are from finance background, it's very simple. Fundamental analysis involves analyzing company's financial statement, how the company's assets are, liabilities are, how profitable the company is, where the company is investing money. Based on this, you will arrive that this stock should trade at this fair value. If current value is less than fair value, you go ahead and buy the stock. This is in a nutshell the fundamental analysis. Technical analysis. What is technical analysis? Well, very few of you might be knowing our technical analysis. Let me tell you, technical analysis is partly a science and partly an art. It relies on a computerized method to track the crowd psychology. Now, this is a very, very, very bookish definition. What I would say in a very simple and layman's language is technical analysis try to forecast the stock price for short term. So today, ICICI Bank is 250. What is the likelihood of the stock after 3-4 days? How you will arrive what is the likelihood of the stock in 3-4 days? It is based on a chart. How historically price has moved. Based on this, we will try to conclude that with the assumption that history repeats itself, and because of that, in a short term, ICICI Bank is likely to go down. So technical analysis is nothing but seeing the charts of the stock and arriving at the likelihood or probability of what's going to happen in future. Derivative. Derivative is nothing but it is a mix. Derivative quant is a mix of fundamental and technical. The only thing about derivative is it helps to leverage a position. You have 100 rupee, you can take 1000 worth of stock. That's a derivative. Intermarket analysis. Now, in a way, you must have heard every intermarket analysis in a day in day out activity, but you don't know that this is intermarket analysis. Now, suppose equity markets are not doing well. Why? Because GDP is not good, the country is not doing well. Then what is the thing which will go up? Gold. Everybody knows that whenever there is a crisis in the market, whenever market falls down, people buy gold because that's a safe haven. So what I'm trying to say is, because equity markets are not doing good, people tend to understand that now commodity market, which is a gold market, will go up. So based on how currency is going to move, we can interpret how equity markets are going to happen. Based on commodity, how equity market is going to react. Basically, you are trying to link each other and try to find what another is going to react based on the phase reaction. How equity market will react based on the currency market. So what markets to analyze? Stocks, that's equity, commodity, options, futures, currency, and there are n number of markets. Which markets to analyze? This is the one of the most important thing which traders get confused. So beginners make a common mistake of trying to follow too many markets. They try to scan thousands of instruments through automated trading. Ideally, what is the recommendation? Excuse me. Ideally, there are 5 to 6 markets which are available. A beginner will say, you know what, I like commodity movement, I like stock market, I also want to follow currency, and I also want to do futures. Well, this is not the way he should approach. Trader has understand that I'm a beginner, I'm a learner. He has to stick to one market, analyze, master it, then go to the second market, then go to third market, then go to fourth market. One by one, he has to gradually evolve himself, but he has to fix one market at a time, get expertise, get hold of it. Very importantly, how to decide which market as a beginner should he be trading. So every market has two elements. First is liquidity and second is volatility. What liquidity refers to? Liquidity refers to a daily average volume. So you know what? ICICI Bank is traded on a NSE. Almost 5 to 10 lakh shares are traded in a market. Same way, there is another company where only 5 shares are traded every day. So liquidity refers to whether that particular instrument is active or not. Volatility. What is volatility? What will refers to whether a particular stock keeps going up and down frequently or not. If this stock is not going up and down very frequent and it just stays at one level, how we are going to profit on it? Higher the volatility, you can buy when it goes down, you can sell when it goes up. This way, if you keep going up and down, and your trading plan suggests when to buy and when to sell, you will be able to capitalize on the volatility. So important two factors which you have to keep in mind while selecting the right market and right instrument is liquidity and volatility. This is what I was trying to convey. How many markets to follow? Beginners make the common mistake of trying to follow too many markets. Ideally, you should follow not more than 1 or 2 markets with not more than 5 to 10 instruments. You know, when you just decide that I'm going to trade only this 5 stocks, so you will keep looking at this particular stock on a daily basis and you will get the hangover of the stock. Oh, you know what? This stock, whenever it goes down and from one particular level, it starts going up. From that particular, it starts going down. This way, it helps to capitalize and get more confidence on your trading activity. It has been seen, and let me tell you with my personal experience, it has been seen the one who has been successful, he just trade on not more than 4 to 5 stocks at a time, and throughout his lifetime he keeps trading in the stock. Why? Because he knows the behavior of the stock, he knows the behavior of the instrument very well, because that is the only thing which he keeps tracking on a day in and day out. Don't try to follow 100 stocks at a time. You want to buy Reliance also, L&T also, and there also, ICICI Bank, SBI, everything you want to buy at a time. No, just select 2 to 3 good instruments and keep watching them and understand how it behaves. This will help you to build a confidence in taking a judgment while trading. So another point which I want to make out is the style of a trading. The style of a trading refers to day trading, a positional trading, a swing trading, and a scalping. A day trading is what is day trading? Simple. A trader who buys and sells on the same day. A positional trading. A positional trader is a trader who buys, hold it for some days and then exit. Swing trader is a very short-term trader, and scalping is ultra short-term trader. He just buys in the fraction of a second he sells. Well, now based on your style of trading, how should as a beginner choose which is the ideal style for me? Ideally, you should choose a style of trading which reduces your stress level. It often happens that whenever you buy a stock, there is a lot of stress which keep coming in your mind. That stress is nothing but a psychology, emotion of fear, greed, ego. All these things keep coming in your mind. So the moment you buy a stock and it gives you the stress, you're not able to sleep in the night. There are people who buy a stock and not able to sleep at night. You should never adopt that kind of trading style. You have to understand, you have to read a lot, and you have to understand your trading behavior and decide which is the better style for me, which gives me a less stressful life. By selecting the right method, you will be able to take a right decision, and also it helps you to follow the right trading plan. So before getting into a trade. Now this is one of the most important elements why I kept this slide in a style of trading, because I want to highlight this thing. The style of trading. Before getting into the trade, the one has to decide and answer two things. What trading style I am doing? What is a trading style which I am adopting? Am I buying a stock for one day? Am I buying a stock for 1 week? Am I buying a stock for just 10 minutes? Am I buying a stock for 1 year? Am I buying a stock for 3 months? You have to define. No, this is the stock which I am buying for 1 week. If in a week's time stock doesn't move the way I expected, I will just exit and sell away that stock. Things didn't work out the way I expected. It's okay. This is market. Sometimes market behave the way you expected. Sometimes market will not behave the way you expect. But you have to accept it and go ahead. So decide before you buy any stock. You have to decide right away that this is the stock which I'm going to buy for 1 day. At the end of the day, if you are making loss, exit the trade and get prepared for the next day. At the end of the day, if you are making loss and you think, you know what, this company is good actually, why should I book loss today? Anyway, this is a good company, it will go up tomorrow. And what will happen? You will carry that position to next day. And next day it will further fall down. And then you don't know what to do. Why? Because there are a lot of emotions which will be playing in your mind. Now what to do? What to do? There is an emotion of fear which will override all your thinking, all your rationals. And it will not allow you to take a rational decision. So that's what exactly I'm trying to form. What style you are adopting and what is your exit strategy. Exit strategy is, and if I buy a stock at 1000 and if it goes up to 1020, I will book my profits. If it goes to 990, 5 rupees down from here, I will exit and book loss of 5 rupees because I'm ready to take a risk of 5 rupees. But the moment you buy and stock goes down by 5 rupees, what will happen? You will start making loss. So what will happen? Your emotions, your psychology will say, I'm losing money. What should I do? Yesterday also I lost money. Today also I'm losing money. Your psychology will be very emotional. Your mind will not accept the loss. You will become emotional. You will become fearful. You will become wishful. You will become hopeful. You will start hoping that stock will start going up. 2 days it has been down. At least third day it will go up. That kind of feeling will come, and you know what? You will say, let me hold for 1 more day. But this is not actually what you have planned. You have planned to hold only 1 day, and this is the third day you are holding. And you know what? Third day it falls significantly. And then you will say, these markets are not good. Equity markets and capital markets and share market is not good for trading. You know, people just lose money in markets. This is not the right place to make money. This is common thing which you always have heard from the people. You know what? Lot of on a Dalal street you go and people will keep chatting all these things only. That market is not a place to make money. लोग आते हैं, लोग loss करते हैं और चले जाते हैं. This is not the right way. Discipline is the right way to survive in the market. Third pillar, which is the money. So let me tell you, there is a 2 goals of money management. That is, one is survival and second is prosperity. So, which is the first goal which I have said? Survival. The first goal of money management is survival. If you don't survive in the market for long term, how will you make money in the long term? That's the biggest thing. I have been in the market since last 10 years and I'm trading on a day-on-day basis, and I'm there. I have built my capital. How? That's because I had set my trading plan and decided what is the right strategy for me. I have decided that if this thing happens, then only I am going to trade. in each and every trade, I'm going to invest only this much amount of money. I'm not going to risk my capital. I'm ready to accept loss. Everything, all my trading psychology like fear, greed. I'm not going to be ego. I'm not going to be stubborn. What market I'm going to follow? Everything has been written on a paper. If you have that, then only you will be able to survive in the market. Suppose your dad gives you 1 lakh of rupees and says, go and learn, go and trade in the markets. What will be your next thought? Immediately, all the participants over here, I give you 1 lakh rupees. Immediate thought which comes to your mind is, tomorrow when market open, what should I buy and what should I sell? Right? This is the immediate thought. And why this thought is coming? Because you want to make profit or you want to make ultra high profits in a short term. But nobody has ever thought, this 1 lakh rupees has been given to me. How should I save this 1 lakh rupees and at the same time gradually build on this 1 lakh to 2 lakh? A survival thing is so important and it doesn't come to the mind of the people. So what I'm trying to say over here is the first goal of money management is survival. The beginner tend to reverse this priority. That's what exactly I was trying to say. The moment you get 1 lakh rupee, you just reverse your priority. You will say, oh, today I got 1 lakh rupee to trade in the market. What they will strive for? A spectacular gain first, rather than saving that 1 lakh rupee, protecting that 1 lakh rupee and surviving for the long term. So important parameter over here is money management has a survival first and prosperity second. So to survive, you have to fix your position size that I'm going to buy only X amount of stock and only this much amount will be invested in each and every stock. Prosperity. What is prosperity? Prosperity refers to the long term. So your 1 lakh has a potential to grow to 5 lakh, but not on one day. It could be 5 years. But provided you protect your 1 lakh properly. So this is 1 hour session. I'm not able to put everything. If you want to know more, you can immediately come back to us and say if you want to learn more things. And this is a very interesting topic. And with this, I'm going to end this 3 pillars of trading. That is mind, which is psychology. Second is method, that is fundamental analysis, technical analysis, and third is money management, that is survival and prosperity. Well, I tried to cover most of the things from my experience, what I can say. I will end the session right now, and we will have a small Q&A session. If anybody has a doubt with regards to any particular pillar or any trading psychology, please do share right away. Right. So this is a question which everybody asks. Well, it's not that easy to answer, but yes, this is a capital markets, and from my experience, I'm saying you may be short of that fund, or you may be having a lot of funds. The minimum amount, what I believe you should start for trading, should be minimum 1 or 2 lakhs. If you have just 50,000 or 25,000 rupees in your account, you have to take a pause. You have to set a goal for yourself that when I will be able to make 50,000 or 1 lakh at that particular point of time, only I will enter. So from my experience, I am saying 1 lakh rupees is minimum required, but that doesn't mean a person who is having only 50,000 can't trade. The only thing is his strategy will be a little bit different than what other has. But yes, the rules of 3 pillars remain the same whether you invest 50,000 or 50 lakhs.
Okay, so the second question is from Lakshmi. She's asking, she's planning to start trading. So how long should she study the market for?
Sorry, I just missed
I'd
the
like to buy
question.
the stock.
I just missed the question. Can you repeat, please?
Lakshmi is planning to start trading. How long should she study the market before deciding to start investing?
Right. So, see, whenever you do your own business, you give a lot of attention to the business, right? You pay attention to who is the buyer, who is the seller, with whom you have taken a loan, what should be your profit margin. Same way, when you are investing, you have to keep tracking the markets. I would say to start off, every week you should track the markets. Every day you should read the newspaper. Every day what's happening with different stocks you should understand. So you start every day, you read the newspaper and gradually start tracking markets on a daily basis. What has happened today? Why has happened today? And try to understand the pulse of the market. So whenever you're starting, you have to start tracking on a daily basis. Just give 15 minutes daily to read the newspaper and see the difference in 1 month of time. The question which is coming up is it always good to invest in blue chip stocks? Not necessarily. There are a lot of non-blue chip stocks which are a mid cap and small cap which has made a phenomenal returns for the investors. So it is not necessary that you should only invest in blue chip stocks. What is necessary is you have to have a trading plan, when to buy and when to sell. After you have a plan when to buy and when to sell, you should now define a universe that which are the stocks to buy and which are the stocks not to buy. So it's not necessary that you should have blue chip. The second question which is coming, how to set a break-even target to get an idea of good targets. Well, this is I will not be able to answer this question in this forum. To set a good target, you need to have a mastery of one of the methods, which is fundamental or technical. So when you start learning either of this method, you will be able to understand what is the method, which method to follow, and how to set the targets, which is good or which may not be good. But yes, I just can't say that 10% is a good target and 5% is not good target. You have to understand which method you are following for buying a stock and selling.